Hello, everyone. Thank you for being here. So this panel is about capital flow. And before I introduce the panelists, I wanted to put some data out there to set the stage. So the first slide, it shows the electricity demand in the US. As you can see, in the past 20 plus years, in our country, the electricity demand hasn't really changed significantly, but we're expecting to see dramatic demand coming up in the future, 40% growth over the next 10 years. I just saw this amazing data point last week at the Transition AI conference. They showed one chart that's saying Arizona Public Service, since inception, 140 years ago, from 1886 to 2026, has built 8 gigawatt of power. And they need to do 20 in the next few years. So that's just how dramatic this is going. So the second page, if I flip to it. So what does this say? The demand, we hear this every day. I don't want to repeat this, is driving from 3 different things. Of course, the first one, data center. I don't want to hear the data center again and again and again, but that's the driver. However, there's also other things driving demand. The second is electrification of everything. EV, heat pumps, home appliances. A lot of these consumer products are driving demand for battery, for electricity. The third is industrialization, as manufacturings are moving back to the US, as we see, because of supply chain disruptions, policies, and there are incentives still in this country. So all of these are driving the demand. Now, what does this mean to all of us here in this room? Opportunities. I think this is creating in my opinion, a generational opportunity for all of us here, investors, innovators, entrepreneurs, founders, engineers, scientists, operators. So the disruption is happening. I think the energy space is being reshaped today. And then going into the next 5 to 10 years, there are a lot of opportunities. Now, this is a battery salon event, so that has to do anything with battery? I think there are a lot of technologies out there that will power the future of AI. However, battery is in the mix of all these technologies. So I think battery is super important. Battery technology range from long duration storage to EV batteries to software to monitor battery health, degradation, state of charge, so battery can have a better long-term performance in the real world. You name it, right? There is different form factors, different chemistries for different applications, whether it's robots or drones. So there's huge demand for battery, and that's leading to our conversation today. So I am going to quickly introduce our panelists. Let me pull out there. This one I have to read. Jeff Johnson, General Partner and Global Head of Energy Tech at B Capital. Jeff has nearly 25 years of investment, entrepreneurship, and corporate experience across energy, technology. Before
I'm going to stop you. That's way too long.
Oh, okay. Anyway, he has a lot of experience.
I've done a lot of stuff around this for a long time, and it's a pleasure to be here.
Scott, principal at BMW iVenture. I'm going to cut short. Scott invests in Series A and B companies in different verticals. And Karen is a venture capitalist, also in the climate tech space. So that's a short intro. Let's dive in. All right, so my first question, let's go back to the principles. Each of you is writing checks in this space. It's quite challenging. And there has been investors who lost a lot of money in this space. What are your investment principles or frameworks to look at a company and decide to write the check. Whoever want to start first.
I'm happy to start. I mean, I've been doing this a long time, and the way I think about it is like start with customers, right? Start with customers, see what they want. I can fall in love with the technology. I'm an engineer by training. What I like doesn't matter. In the end, it's what customers want to buy, and what solves problems fast enough that they're willing to like move with urgency to adopt something. Because I think a lot of times we think this is cool, this is impactful, this can be meaningful, this can cut costs, this can do this and that. But if there's risks, if there's challenges, if it's going to take forever to commercialize, then you're just not going to get there. I mean, we did this a few weeks ago, last month, and I kind of quipped that there's a new worst customer in the world, which has moved from electricity utilities to car manufacturers, and you can comment on that. We're still friends. But it's really hard, right, to go from nothing with a battery to like scale that can meet their demand. And so, I think so we just have to figure out, again, how to weave this through an industry to make it work, how to make companies like yours, if for the entrepreneurs in the room, have the chance to be successful, to start to get scale, to start to prove you've got a real business. And like figuring that out is important. So like, again, the customer side, how engaged are they? What's a real path to succeed? And, preferably you don't need to use $10 billion to make that work.
I gotta echo that. So I mean, he said it best. I mean, you know this because you're involved with us too. But like, a big part of our thesis is really investing in companies with Fortune 500 traction, and that is because of my background as a Fortune 100 finance executive for 16 years before becoming an early stage VC, which is not a normal pathway. You really found myself really accidentally in the VC world as an early stage investor at that. And in early stage is really difficult, right? Being a pre-seed VC is very, very hard. I think Series A, B, then you have more, more to sink your teeth into. But when you're starting at pre-seed, really, how do you demonstrate that customer traction? Well, it looks like what my colleague said here, right? Like, are you talking to customers first and foremost? And at risk of sounding like YC, build something that people want to pay you for. That is ultimately what should matter, right? Like
It's really good advice.
I mean, it really is. I condense it to that because honestly, we can build all these cool science projects. My husband is a physicist, so I know the brain, right? Like, I mean, this is an elegant solution. Let me show you how we roll up the burrito. I'm like, none of it matters unless you can sell. Otherwise, it's going to be beautiful and stay on a shelf and never get to commercial stage, right? So at pre-seed, what I'm looking at is like, really, do you know your customer? Have you talked to enough people to validate that this is the pathway you want to go into? Because it's a really treacherous journey. If you're planning to raise VC money, you are in for a treat, right? Really, like a lot of expectation of fast growth. Not only do you have to actually care to meet the demand of a customer, but now you have to actually respond to your VCs. And so it's just like a whole thing, right? So,
I think that when you think about what a startup really is, it's a massive exercise in risk mitigation and how you actually mitigate risks over time. And you've got two big types of risks as a startup. You've got market or demand side risks, and you've got supply side risks, things like your technology, your ability to manufacture, ability to stand up a supply chain, permitting regimes, right? And so what I always recommend for startups to do is to start with that in mind and say, okay, if I reach the promised land and I'm a big, successful, self-sustaining company, what do I look like? Then what do I look like today? What's my traction along those vectors of risk? And then what do I now need to do to systematically start to reduce that risk over time? And when we put capital in, and we're typically at the Series A or B stage, so we're kind of I'm in the middle of these two. We're looking for some level of traction along those vectors, and then we want to put capital in that's going to help you extinguish your technical risk and really move down the chain in terms of your market risk. And like Jeff mentioned, automotive is a really hard first customer. It's a terrible first customer, right? Like let's be honest, the qualification timelines are massive. The contracts that come out are hard and not favorable to startups. And OEs are used to working with tier ones that are also big companies that negotiate sophisticated level contracts. And so what we always try to coach our companies on that, how do you get there then? How do you actually start to mitigate that market risk? It's, okay, find some other adjacent markets that maybe aren't your big TAM openers, but you can start somewhere and say, hey, I can start selling to maybe some other startups in the space. I can start selling to markets that maybe have a little bit easier qualification standards and contracting mechanisms, and then make progress along automotive, because automotive, like I said, is not a great first customer, but they can really make your company. And so it's kind of a dual prong path that I always try to coach our companies.
And just to the dual prong path is really important. I think a lot of this industry has a lot of technical founders, a lot of science PhD founders who are brilliant folks who, think a lot about technical R&D. And this dual thing is important. You have to do commercial R&D right alongside technical R&D and think about it as just as important. And so if you bring that level of urgency in that parallel path, I think it's one of the most important things you can do.
I cannot agree more. My current company, SDSAI, we worked with GM, Hyundai, and Honda as the first product to go to market, which was very painful. I was like, how about we make a 10 amp hour cell and sell it to drones, and before we get to 100 amp hour and try to sell it to the OEMs. So totally agree. Let's dial it in a little bit. So I
was hoping to be controversial. I guess I got to do a better job.
We all know how hard it is to work with auto OEMs. So dialing in the battery technology a little bit, I have seen companies come and go, technologies that look so good on paper in the lab, but never able to commercialize and scale up. And scale up has been a real challenge for the battery industries, especially in the US. And my question is, for you guys, one, are you investing in battery space companies? And then a lot of those founders and companies are early, so they haven't demonstrated unit of economics, cost, or a capability to scale up because it's so early. What is your thesis on that? Is there anything that you're looking for in order to say, I will back up this founder and this company? It's a tough one. You can say no, by
You're
the
the
way.
earliest investor. Do you want to start?
Yeah, we can go in
I'll
the
go
order
last.
of stages. Yeah, it is hard to invest at pre-seed seed in these things. But we did back one company that is doing bi-directional EV, super fast, ultra fast EV charging, and then battery back, so it provides energy to the grid on demand. So they have these two sources of revenues, right? Like rev share for storage, energy storage, like deploy immediately to the grid as needed. And we all know the duck curve of, or I assume like a lot of people nodding heads here, like I feel like I'm talking to the folks that understand that. And then on the other end, they have these modular units that you can literally wheel into a parking lot. Half of a parking lot takes up an unit. Is that true? Charge EVs for under 10 minutes, 200 mile range. So it is Electric Fish. They're based here in San Carlos. Actually, there is a tour facility tomorrow that is part of this summit, so I encourage everyone to go. But yeah, so when I was going through the motions of the diligence, and by the way, they were targeting OEMs as the first customer, and it was also really brutal. And so like now they've unlocked other kinds of sources of revenue. So like they're partnering with gas stations.
Sorry, Scott.
So yeah, but I mean, finally they're hitting that point, right? Where like there's an inflection point they hit now, where they're partnering with gas stations, and I think they signed 31 gas stations in 30 days, and so it's finally at an inflection point. It is hard at the beginning, and so I think the things I'm looking for are that founder product market fit, right? Like, I mean, is the founder someone who I can see, is the team credible, and then have they done something in the past that had to do with executing? A pre-seed is more about the founders than more than anything, really, because you know the technology and even the market adoption or the market, the go-to-market strategy is going to pivot. Pivots are normal. They're not to be scared. And I think some VCs do get scared of it because it depends. There's a pivot and then there's a pivot, right? But I do think that early, when you're so early, my expectation is that you're going to tinker with some things along the way. And hopefully you're not so enamored with your product. You're more obsessed about solving a problem. So I think what I do find with a lot of technical founders is they really get very obsessed about it's in front of them, and they've been toiling into it for months or years sometimes, when the better solution is staring at their face, and it's the one that they can actually sell and commercialize. So I think what I'm looking for is the ability to really learn and like really pivot quickly and learn what is it that customers want. So hopefully that makes sense.
No, makes a lot of sense. And so when we're looking at companies, we spend a fair amount of time trying to understand the unit economics of those businesses. And this is the most observable data that you're going to get today in terms of the ultimate financial performance. And it's really the output of what your value proposition is around the market side, and then also your ability to deliver that, kind of again on the supply side. And so when you talk about unit economics, you've got really two sides of the same coin. One, we're looking at, okay, do you have really attractive product level margins and profitability? But can you also get to, from like a four-wall standpoint, if you need to build a project, you need to build a facility, you need to build a manufacturing line, like, do the unit economics work at that four-wall or project level? And when we're investing, it's usually early and that data isn't all there, but we do a fair amount of work trying to understand and project those out and leverage other external sources to help us make educated guesses. The reality is that, for us and most investors in this ecosystem, you have to have a big enough or a step function level of improvement in what you're offering in order to both have successful unit economics and to deliver the TCO benefits or the overall benefits to your customer. And that ROI equation has to work there. And it has to work better than not just what's out there today, but this industry is rapidly evolving, right? The rate of progress, just as the status quo, is like 3 or 5% price performance improvements every single year. So today you're not competing against what exists today. You're competing against what's going to be there in 5 years. It's going to be 30% or so better. So when we look at companies, and for example, we made an investment in an early stage battery company last year called Estes Energy, which was the former Proterra founders backed this company or founded this company. And what was so interesting there was that they were able to demonstrate a step function improvement in what they were bringing to market. They had great founder market fit because they knew the customers, they had delivered before at scale, which is a bit unique. And from a unit economic standpoint, it was really pretty interesting where we came out, and there's enough wiggle room there that you can say, hey, even if you're off by one order of magnitude, things still things can still work out quite nicely. So yeah.
Yeah, unit economics is really important. I mean, I'm the latest stage investor, do like Series B through pre-IPO companies, and your point about something like being meaningfully better is important. Like a lot of these industry we're in, there's like a lot of vitamins and very few pain pills, and like let's find the pain pills. Again, that's really an important thing. I actually wrote a paper that's on our website at B Capital. It's called like the 10 factors that guide our growth investments. So I actually, kind of from where I sit, I got asked this question all the time, and there wasn't a lot of good stuff out there. So I kind of wrote something and shared it. So feel free to check it out. But what I really tried to do there was to say like, so much of what I was getting from earlier stage VCs and founders was telling me again, like I said earlier, how awesome the tech is. Like I don't really care. Like show me that the unit economics are good and show me people want to buy it. And show me you've got a team that has the capabilities to not just invent it, but scale it and actually execute. Like that's the stuff that matters. And so, talked a lot about that in the paper. I wrote another one with kind of the former folks at the DOE in the last administration about how we use the adoption readiness level framework to think about things, because it's not about TRLs, it's about whether you can adopt it and get it out in the world and use it. And so I think those are the things that really matter, especially by the time, people are coming to me for a $20, $50, $100 million check.
I totally echo on Scott's points on the step change, because I've worked in battery companies where when we started, the technology is better, but then 5 years later, the regular technology is already 30% better. So now we need to be 30% better than the 30% better. So it's a progress. I wanted to ask a recent investment. I think Scott and Karen already kind of talked about it. Maybe just Jeff, like a recent investment that you've made and why?
Yeah, so we led Lunar Energy's last round, and Rishi from Lunar is here in the room. I think he's talking up here later, which is great. I think the things I was just talking about, they've done a phenomenal job on. I mean, what they've been able to do, which is build a really differentiated both hardware and software technology. I feel like I'm being graded by the teacher here, see if I do a good job. They've got a really phenomenal product that's both hardware and software. They've been able to demonstrate their go-to-market in a very repeatable way. They've got a very clear path to sizable revenue now and are selling into just a gigantic market with what I think is an absolutely stellar and phenomenal team. And so they've been able to kind of while a lot of people are talking, a lot of people are telling good stories, a lot of people are doing whatever, these guys have delivered, have executed, and have a product that's really ready to scale. And the market's moving fast. There's a lot of stuff going on. And the other thing I see them doing really well is thinking about these assets that they have, this business that they're building, and not how do you tweak the product, but how do you make sure you can meet the market, you can meet kind of that with what they have. And so it's not about hardware takes a long time to build, so you can't constantly fiddle with that. But if you really build a phenomenal starting point, differentiated kind of architecture, and then you can have a path to scale and then have a lot of optionality about how you do that in different markets, you can build a really, really big business. And so I'm super excited and proud to let that investment and be on the board.
My next question, so we're in the battery space. It's hard to avoid talking about China when you're in this space. China, through a lot of government incentives and very coordinated way, have clearly dominated the space, both on the battery materials to the actual cell, to module, the entire supply chain. But these technologies, a lot of those was started or invented in this country. So when we think about the global environment in this space, what is your view when you look at founders, companies in the US, whether they're investable or not, and how they compete with China, who is moving, in my opinion, at a so much faster pace than we are in this country? Things are moving. I hear the word speed to power every single day, but in reality, things are moving pretty slow for many reasons. So what is your view when you look at companies here in the US trying to compete with these gigantic players from China or even Korea, Asia in general? How can they think about being competitive, or anything that you can talk about?
I mean, it's a question of what's a venture investment and what's not, right? And so some of these things, if you're talking about the need to build gigantic, tens of billions of dollars of factories and facilities to try to get the scale down like that, that's not a venture investment. That's something different. And it's important. We should do it. We should find the capital. We should find the way to bring the government and large businesses and people together. But to me, that's a very kind of different game, and it's very hard for venture capitalists to beat unless there's someone in the room, which would be awesome, who's got the next generation of that can be kind of a tenth of the cost and 50% better. I think that's the chance there. I mean, I just got back from Singapore and Hong Kong on Sunday, and met with a bunch of companies in Asia. And when I was in Hong Kong, some of them came over from Shenzhen, and I'll tell you, I mean, it's going incredibly fast. I met one company that the founder had left Huawei in 2024 and is going to do 200 million of revenue this year. All right, that's the speed, that's the scale that we're talking about, and I've not seen that here. And so, I do think part of that is, the ecosystem advantage, but I think, there's also, moving really fast. And so I do think there's a urgency that needs to kind of happen for our collective, all of us. But I also think we need to better find roadmaps that can help us really, really succeed and kind of figure out all of our places in that and kind of play those positions well. Because if we misapply capital, if I put growth equity into something that ultimately fails, like that actually sets us all back instead of actually helping move us forward.
Yeah, maybe I'll just add to that. I see the same thing in China. I mean, it's amazing how fast. It's amazing how fast that they're building, and at the cost that they're able to do it, and how efficient they are. The yields, the scale, it's really impressive. And so here, when we're looking at companies, we're not expecting that today you're going to be able to go head to head with some of those that have been manufacturing batteries for 20 years. But the innovation that underlies what we're trying to commercialize needs to be able to go pretty close to head. And so it's a challenge, and it's not going to happen all at once, and it doesn't happen at the seed or Series A stage, but it needs to have a path to ultimately get there. Ultimately, in the US, like there's a lot of movement to reshore battery manufacturing, and it's going to take time. And a lot of folks, I think, underestimated how hard and how capital intensive that is and just to build the labor force that has the knowledge and expertise to really do this here. But as we do, we'll start to approach the scale economies and the process power that exists there. So this is happening slowly over time. But so for companies that are creating new innovation, you need to be able to plug into that ecosystem and ultimately be able to deliver big enough, again, like not to keep using this word, right, but like that step function level improvement that's going to be additive to that case versus something that's a little bit more marginal that ultimately gets kind of washed away over years of compounding just regular improvements.
Yeah, and I guess the last thing I will say is, like, this is a panel discussion called capital flow, so it does require all kinds of sources of capital, not just VC, right? Jeff correctly identified. We can. It's not VC investable to invest in things that are like gonna take multiple, like so much capital, right? Like if it and create factories. I think we need like a number of different capital players along the road, right, of building something so huge and massive, right? And so to me, that means, like, what does it mean to not have to rely on China so much when it comes to batteries? It means creating a domestic supply chain of these materials, creating a manufacturing scale, at scale too, right? So it takes a number of complex and a variety of capital partners. And so I've seen many companies do this successfully, just like starting early, like, like seeking those partnerships, maybe labbing out of a corporate, partner that wants to, and then moving on the stages that way. And then modularity is a word right now, right? Like everything is going modular right now and widely distributed. So I've seen some solutions that are like, there's a couple of founders here that are building interesting stuff to secure critical minerals and materials for batteries, right? Like domestically, really secure a supply, domestic supply. I'm looking at one of them here in the audience. But like, so, like it does take a lot of capital. It will take a number of capital providers, not just VCs, and maybe not even most VCs, right? Because it's not.
For me to build, I mean, we can do capital intensive things, and some of them can be venture backable. So it's not that if you need a lot of capital, there's no potential for that. I don't agree with that entirely, because I do think it's possible, but it's got to be done in a very kind of step-by-step disciplined way. You have to buy down certain risk, prove technology, prove commercial, start working on how do you de-risk both of those things as fast as possible to allow more non-dilutive capital in. How do we find, it's a lot easier to find the small number of areas to finance that we don't have the political football ever how many years go around, that you can have some level of consistency there. And I think that, this is an industry that has the chance to be sort of one of those. I led a company called Fervo's last round. Geothermal is one of those that's found a way to do that really, really well. And so I would encourage everyone who's working on this to find a way to be a bipartisan middle thing that's solving the nation's problems rather than turning it into a green argument that frankly half the country could care less about. So I think it's things like that. So I think if you can find the right way to do it, I just don't want people to be afraid of saying, oh, this needs capital, there's no chance. You can, and it's possible, but like you really have to think hard, not about just technology de-risking, but commercial, financial, do it step by step, work with our friends at JP Morgan to help you plan for that, but it's all part of the work that has to be done, and it has to be done early.
Yeah, and maybe just to build on that, we've backed a company that's doing engineering work now on a project that's going to be more than $500 million, right? But we've been very thoughtful over years of how do you extinguish all of those risks, right? Like from the backcasting that I was talking about earlier, what's your promised land? Okay, well, how do you actually finance a $500 million project? What risks do you need to? Someday I'll figure this out. How do you actually finance it? And in order to finance that, what risks do you actually need to mitigate? How do you build a pilot and a demonstration scale facility that has the full flow sheet, that has the right sorts of feedstocks and output in it? For another company that I mentioned earlier, for Estes, right? Like they've got a path to use much less capital, tens of millions, to generate hundreds of millions of revenue. And so there's all sorts of different paths, and it's okay to be capital intensive, but it's understanding today, how do you actually finance that end state, and then making sure that you're doing all of those things today and making the investments you need to in order to be on that track.
All right. My last question, you have seen a lot of founders, you've seen people succeeded and failed. If you were to give one advice to founders in this room or innovators, companies in this space, what would that be? A common mistake or one piece of advice?
I'll hold the microphone in the right place this time. So I think it's a focus on, I think technical founders fall into the trap of they're very, very good at technology and innovation. And so it's very natural to kind of fall into, this is where I'm going to spend 80 or 90% of my time. And I'm going to hey, if I build it, they will come. The commercial piece will take care of it. The fundraising piece will take care of it.
Never happens.
Does not happen that way. Honestly, as a CEO, a big part of what you are doing all the time, if you're not spending half of your time or a big slug of your time talking to customers, talking to supply chain partners, talking to investors, even when you're not fundraising, like these are the things that just take so much more time, and to be so thoughtful about, again, your approach as a strategy, like we were just talking about. It's about having the relationships with capital providers so that when you do go into market and you go to raise that round of capital, that you already know folks and you kind of know what things that they're looking for. Like that job as CEO is very different than just pure technology. So the technology is critical, but we just see oftentimes that other piece of the puzzle is underinvested in.
Yeah, I mean, I've said a lot of the things that I think I was going to say, and I've talked about some of the papers I've written. You can find on our website. So, just to reiterate what Scott just said, like in the end of the day, you're building a business, and you're not fiddling with the technology. You are building a business, and that means, if you're a CEO, your job is to, chart the course and hire great people and raise money. And like if you don't want to do those things, be the CTO and find a CTO that wants to do the job, and like be honest with yourself, right? I mean, so I think that's the most important thing, is like know what you want to do and what you're good at, and put people in the right seats and build a great business, but know you're building a business in the end.
I mean, I concur with everything that has been said. I mean, I invest at pre-seed, but even at pre-seed, I can tell you, my biggest filter is enterprise adoption. Like, do you have large customers that are wanting to buy your product? And so are you building for customers, right? Like, I mean, Another thing I say, your customers are your best investors. Really, just go chase them first, then come back with attraction to the VC and not the other way around. It's going to be very, very painful. So know what investors are the best in your cap table, right? You don't have to corner yourself into a specific segment or sector. I see a lot of founders come to a climate tech VC, so only climate tech VCs. It's like, you're building something. Actually, I had a founder said that to me, I was hoping to get more climate tech VCs interested in that. Instead, I'm getting logistics VCs, manufacturing, legacy industries VCs. It's like, and your problem or your complaint is what? Like, you're getting a ton of interest. That's good, right? That you should feel good about it. Build a cap table for the ages because you're building a generational company. Hopefully, right? So you can choose your investors. Well, maybe there's gonna be choosers. I should know this. When I talk to LPs as well. But you really can, right? So you go build the relationships with the VCs and investors you would want to have, and then I think the best time to fundraise is when you're not fundraising. Let the traction speak for itself, right? Because it shows very clearly that you are focused on the customer, which is what matters at the end.
But to just build on that for a second, it seems it's really important. Some people who have a more technical background say, well, I don't know those people. Well, maybe go work for a big company for a while to start to get to know those people and then go back to start a company. That's perfectly fine. Leverage organizations like what's happening here to go find those people, but really seek it out, really go do that work. And if you don't, enjoy doing it, figure it out, because otherwise you're not going to succeed. So I just think that part is, a lot of people are saying, well, my technology is amazing, people will come to me. Absolutely not. Work really, really hard. If you don't have the relationships, build them. There's lots of ways to do that. I think a lot of people, and it's what Scott and his team does, is to go find folks, make connections, build things. So, really work hard on that part, and I think that changes the odds.
Thank you so much. I learned a lot. I hope everybody learned something. Thank you so much for being here.
Yeah, of course.
Appreciate it.
Yes, I know, right?